So if you're looking to refinance your property, you're going to need to make a decision in most cases of whether you want to escrow for taxes and insurance or not include escrow in your new mortgage. So what are the implications of all this, and in what circumstances should you include them, and what circumstances should you not include escrow? I'm going to break all that down for you in today's training. Hi, it's Robert Weinberg, and on this channel we help individuals to achieve freedom through expert mortgage and financial strategies. If you're new to the channel, go ahead and hit the subscribe button and also hit the bell so you get notified on any and all of our future content. So in today's lesson, we're going to talk about escrow account considerations when you're refinancing your property. First of all, let's explain what an escrow account is. So an escrow account is also called an impound account. And it's a set-aside account set up by your mortgage lender to pay for the property taxes and the homeowner's insurance on your property. Now, also make note that if you're in a property that has flood insurance, typically, if it's not a condominium, that flood insurance will also be included in that escrow account. So you may not really have a choice of whether you can include escrow or not. If you're getting an FHA loan, a VA, USDA loan, or if you're getting a conventional mortgage with more than an 80% loan to value, then you're going to be required to get escrow, regardless of what you want. Now, if you're in California, I know the rules are a little different, but other than California, these are the normal standards. So you may not have a choice of whether to escrow or not. But if you're getting a conventional mortgage and your loan to value is less than 80%, meaning you have at least 20% equity in your home after the refinance is completed, then you will likely have that option of including or not including escrows. So let's talk about some implications on what this really means. When you're setting up your new mortgage, they are going to need to collect money in that escrow account so that there's enough in there depending on when your property taxes and your insurance is due. And this is normally going to be tabulated up front as an estimate by your loan officer or mortgage advisor, and then on the back end by the closing department to ensure that there's enough money in that escrow account to pay out the property taxes as well as the different insurances that you have on your property when they come due. Now, this can add thousands of dollars to your closing statement and to your total loan amount. So if you're someone that's really pinching pennies and you don't want to add extra money to your loan amount, then that may be one reason why you may not want to include escrow. That's not really the main reason, but it is something to consider, is that prepaid escrow account will add quite a bit of money to that bottom line figure when you're doing that refinance. So the main reasons that you want to look at to not escrow is, number one, if you're self-employed and you're someone who has income fluctuations, if you're on a commission type of job and maybe some months you have great income coming in, $5,000, $10,000, $20,000, and then other months, maybe you only have a little bit of money coming in. So those are good reasons why, if you have that income fluctuation, you would not want to escrow, because it'll keep that mortgage payment down as low as possible, and then it'll actually allow you in those good months to create your own little set-aside account and pay those property taxes and insurance when they come due. So that's really the number one reason that I've seen for people not to escrow, is to keep that mortgage payment low and allow themselves to pay the property taxes and insurance when they come due. Also gives you maximum flexibility with your mortgage payment, so you can invest the money elsewhere. So as we've talked about in other trainings, you may have other options and opportunities where you can invest your money and earn 5, 10, 15+%. So if that's the case, you may get a better bang for your buck and a better return on investment than putting money in an escrow account if you're financially disciplined and you can handle doing that on your own and staying on track with everything. Then that may be another good reason why you wouldn't want to escrow in your property taxes and insurance in your new mortgage. Now, as far as escrowing, for most people, escrowing does make sense. If you're someone who's on a salary at your job and you get the same amount of income every month, or if you're someone who's on a fixed income, maybe you're retired, you get a pension, Social Security, annuity, that sort of thing, and every month you have a consistent amount of income coming in and it doesn't really fluctuate, I think that for most people that's the situation, and you would want to escrow. It just keeps your mortgage payment very consistent. You know the taxes and insurance are paid when they're due. You don't have to worry about making multiple payments to different places, and it's all included in that monthly mortgage payment. So this is something that you'd always want to discuss with your mortgage advisor, and maybe look at the different numbers of whether you escrow or don't escrow to determine whether it's going to make sense for you. And keep in mind, if you're someone who opts to not escrow, you do have to have a little higher level of financial discipline, since you will need to plan ahead to pay those property taxes and insurances when they come due. I do appreciate you watching this, and I hope that you've learned something through this lesson today. Please share this with others and comment below if it's been of value to you. As always, you can follow me online, and you can reach out to me via social media or phone or text if I can be of assistance to you or anyone that you may know. We'll talk to you soon.